The main focus of this year was on the restructuring. Since we last updated you at our interim results, we've successfully implemented a number of changes to create a sustainable platinum business for the future. We've identified revenue enhancement and cost savings of 3.8 billion rand to be delivered in 3 years, and we've successfully delivered 1.9 billion rand of that 3.8 already in this past year. This year saw us return to profitability, with headline earnings increasing by 2.9 billion rand from 2012. And this was despite a number of once-off restructuring costs that impacted our results. Operationally, 2013 was again a tough and a challenging period for us. A number of headwinds impacted our production, including intermittent strikes, safety stoppages, and the industrial action that was taken over the retrenchments. Notwithstanding these headwinds, we delivered a solid operation performance. Sales volumes were at 2.3 million ounces, in line with our strategy. The JV operations also had a strong performance. And in a period of high mining inflation, with wage and electricity increases well above CPI, we've successfully managed to contain our unit costs to 4% increase year on year. As part of our platinum review, Rustenburg operations have been reconfigured from 5 mines to 3 mines, taking out unprofitable, high-cost production. This was in spite of a difficult labor environment during the year and 4.5 months less production at those impacted mines. And with those reductions, the Rustenburg mines still managed to increase their production by 13,000 ounces, or 3% year on year. Also, as part of the restructuring, Union North and South mines were combined into one, with the Union North declines having been put on care and maintenance. This had a partial impact on production at the mine, decreased the production at Union mines by 17,000 ounces. Tumela and Dishaba at Amandelbult had lower production, mainly as a result of a decision taken by management not to increase vacancies that had become available due to natural attrition, so that we could allow for the redeployment of employees from Rustenburg to the Amandelbult mines of Tumela and Dishaba. So that was the primary reason, but there also were a number of production headwinds, mostly associated with labor. We managed to go through a very difficult year with the restructuring last year. We'd made it clear that we needed to reduce unprofitable production and align our production with market demand. And as a result of that, that led to the restructuring, and that actually was dominant in 2013. So it meant that we needed to go through that restructuring. We needed to shut down mines in Rustenburg from 5 mines to 3. In August, we shut down Kusaleka 2, Komanani 1 and 2, and then also combined Union North and South into 1 mine. So a very difficult year. We needed to restructure our head office. We reduced approximately half of the number of overhead people in the company. So notwithstanding the very difficult operating environment, we also were able to increase production from the strike-affected number of 2012. So we're not seeking to increase production above 2.3 million ounces, which we've stated in our strategy. So we think that's the right number of ounces to produce for the company. We were able to produce that, notwithstanding some industrial action around the restructuring. We were able to produce 2.3 million ounces, refine 2.38, and then sell 2.3 million ounces. So I think we've had a good year from an operating point of view. So as I said a bit earlier, I characterize this year as a solid operating performance in a difficult environment. At the same time, we were able to keep unit costs pretty much below inflation, but certainly well below mining inflation, as a result of a number of our cost-saving initiatives. So increasing the unit costs only by 4% year on year, at the same time as delivering 1.9 billion rand of savings through our restructuring opportunities in the company. We're not expecting any more write-downs. So I think we've taken those. Already this year we wrote down 2.8 billion rand of assets, as a result of the mines that we've stopped. Now, we're not planning to stop any further ounces. The only thing that could have an impact on what those operations in particular at Rustenburg would look like would be sustained strike action, which would make those mines really unprofitable, which would mean that we need to look at that again. But other than that, we believe that we've now done the reconfiguration of our mines, and we need to now focus on embedding the cost savings that we've already got, getting the further cost savings that we've identified, and making sure that we embed the changes that we've brought to this company, and at the same time now focusing very extensively on efficiencies at the operations. The demands that are on the table by AMCU are completely unsustainable. So demanding an increase or a doubling of the wages, and in a time when, again, we increased our debt levels this year. So if we were to give, just as an example, if we were to give the demand that is on the table at the moment, if we were to give that increase, it would increase the costs of the company by 13 billion rand. Now, we've already increased our debt levels from 10.5 to 11.5 billion rand this year. And all that would mean is we just close the company down. So we're not close in terms of the percentage. And at the moment, it's the company trying to find a sustainable percentage that the unions will accept. But at the moment, there's a philosophical demand on the table rather than a realistic demand about what companies could accept. So we're not close, but we have to find a solution, and eventually we will find a solution. But the companies can't give in to an unsustainable increase, because it'll just mean that jobs get reduced and we have to shut down mines so that we can keep mines that are profitable running. Now, clearly, it's in our interest to keep all of our operations as we've restructured them now. It's in our interest, it's also in the interest of labor, and to keep those mines running.